Hi everyone, my name is Nigel May. I'm a tax partner at Gravita. The purpose of our chat today is to go through pre-6th April or pre-1st April tax planning for companies, 6th April for individuals. It's also to go through where we are and things that business people and individuals need to be thinking about at the moment from a tax viewpoint. So where are we now? We had the autumn statement back in November 2022, Jeremy Hunt's first foray out in that regard. It was more like a mini budget. There were a fair number of tax announcements made, but that will be followed up by the spring budget, 15th March 2023. The last year has been quite extraordinary in a number of ways. We've seen inflation bite really seriously for the first time in over a decade, and base rates, I was going to say, have shot up. I think from a historical context that perhaps it's not a case of shooting up, but certainly base rates have increased today to 4%. Perhaps they'll go a little bit higher. But that changes how the tax system works, and we'll go through that. The position that we're in today needs to be looked at against the context of the political cycle. And we're in the position where the next election is no later than 24th January 2025. Now, I suspect that we won't quite get to an election that late, but I think the current government will try and see out their term substantively. That means that the budgets in 2024, budgets in 2024, will be overtly political affairs, and possibly means that the budget this year will be a bit of a damp squib, but we'll see, and I'll comment further on that as we go through the presentation. So what are we going to cover today? Firstly, the corporation tax rate, 25% with effect from 1st of April 2023. Annual investment allowance and capital allowances, very important for businesses. Changes to R&D tax credits. As I mentioned earlier, the impact that increased interest rates may have on certain different business sectors and certain different situations. We'll look a little bit at the comparative cost of extracting money by way of dividend on the one hand and salary on the other. We'll also cover a little bit about how perhaps you can be clever and fund school fees, etc., through arrangements from a grandparental viewpoint. And I'll comment generally on other tax issues that are material to where we stand today. So starting with the corporation tax increase. Now, of course, this is quite controversial. The corporation tax rate has been fixed at 19%, regardless of the size of the company, for a number of years. And an increase to 25% is certainly not welcome and has been criticised extensively. I personally, whilst there's been calls for the increase to be reversed, I suspect that we will see this increase going through. I wouldn't be surprised to see then a decrease in corporation tax, probably modest decrease with effect from 1st of April 2024. But for the meantime, we have to deal with a 25% rate. Now, we're in the position where there is still a 19% corporation tax rate for small companies. And the but the relief is really very, very small. So it's only profits of up to £50,000 that can be taxed at 19%. Profits above £250,000 are taxed at 25%, and between those two bands, the tax rate is 26.5%. So that gradually increases the average rate from just over 19% at, say, £51,000 to just below 25% at £249,000. Unfortunately, this isn't a case of then forming, let's say, 10 companies to benefit from 10 small companies bands. The bands are shared between the number of companies under common control. And whereas up till 31st March 2023, we have looked only essentially at grouped companies for the purposes of working out things like when tax is payable, etc. We've got the reintroduction of the concept of associated company, so that sister companies, i.e. companies that are not grouped, are nevertheless brought into account for the purposes of working out whether small companies rate is available, and also importantly for larger companies whether quarterly installments are payable. Now, if we look at the last time that we had small companies rate corporation tax, the band was between 300,000 and 1.5 million pounds. And to put it into context, when I started doing tax some 3 decades ago, the figure was 100,000 and 500,000 pounds. So the small companies band is really de minimis and actually really quite stingy. So, as I mentioned, reintroduction of associated companies means small companies rate is shared, and we need to be very careful about making sure that companies that fall into quarterly installment payments as a result of this are aware of the risk. Now, to put that into context, to explain the position, companies generally with profits up to £1.5 million will pay corporation tax 9 months after the end of the accounting period in question. In contrast, where companies are viewed as large, i.e. over 1.5 million, with division between associated companies, basically you have to pay corporation tax 6 months during the corporation tax accounting period, 9 months during the corporation tax accounting period, at the end of the accounting period, and 3 months. So it's a significant acceleration of the tax. Now, that just needs to be kept under review. It's worth understanding that the impact of an increase in the corporation tax rate is with us already. So taking, as set out on the slide, an accounts period up to 31st December 2023, i.e. 1st of January to 31st December 2023, the corporation tax rate will be worked out on a composite basis, with 9/12 being taxed at 25% and 3/12, i.e. the period up to 31st March 2023 being taxed at 19%. This does mean that companies that have got skews in where profitability arises need to look very carefully at their accounting reference date. In particular, say for example, if a company has realized a large chargeable gain, for example in March 2023, you may well want to truncate your corporation tax accounting period by shortening the set of accounts, basically to ensure that the gain all falls to be taxed at 19%. Moving on, capital allowances are important reliefs for both unincorporated and incorporated businesses. To explain them. Basically, depreciation is not generally an allowable deduction for tax purposes, and capital allowances operates to give relief to companies and unincorporated businesses in respect of items of plant and machinery, fixtures, etc. Generally, the rate is 18% per annum, or 6% allowances are available for fixtures, etc. That operates on a writing down basis. So if you spend £100, you would get, say, £18 in year one, and then 18% of £82 in year two, etc. We do have a very important relief, and that is the £1 million annual investment allowance. That was due to go down to £200,000, but has been extended permanently to the figure of £1 million. Now, there's no such thing as permanent in taxation. If things change, things change. Any chancellor is empowered to change the tax system as they see fit. But the preservation of the £1 million annual investment allowance is one of the few bits of welcome news that has emerged over recent years. And whereas it may well have been that we were having to accelerate expenditure to benefit from this allowance, we're probably not now in that position. Do remember that this is a use it or lose it relief. So making use of your annual investment allowance is important. The other important point to note is that you can allocate the annual investment allowance as you see fit. So typically where you've got a mixture of 18% and 6% qualifying expenditure, you will allocate the annual investment allowance firstly against the expenditure which would only gain 6%. Now that becomes particularly important, say for example, if you're fitting out a premises, etc. We have had since the initial announcement of the increase of the corporation tax rate to 25%, a super deduction for capital allowance purposes that is due to end on 31st March 2023. Now, what this did was give 130% relief for expenditure that would qualify as main plant and machinery, and 50% for fixtures, etc. So to put that in, what does that mean? So if you incurred expenditure of £100, it would be deemed to be £130 for the purposes of capital allowances, or if it was fixtures, you would be able to claim an immediate relief of £50. Now, to put the main pool expenditure into context, with 19% corporation tax, effectively the super deduction gives you 24.7% relief. And that shows why that super deduction was there in place, because why would businesses otherwise incur expenditure securing only 19% relief, where if they were to defer it to 1st of April 2023, they would get 25%. The 50% relief for fixtures, etc., was actually more generous, and you know, lots of businesses have made good use of it. The question has been asked: do we expect this to be renewed and ran over post 1st of April? I suspect probably not. The reason why I might be wrong on that is that at the end of the day, growth is important, and getting businesses spending on upgrading their facilities, their items of kit, etc., is important to that end economically. But I suspect that it was effectively a sticking plaster in the run up to 31st March 2023, and we will see that go. But that's not to say that, you know, planning your capital expenditure is not vital. And the £1 million AIA is a generous relief. Again, it is spread between group companies, etc. So, but you can, there's a great deal of flexibility as to where you choose that expenditure to fall.